myself, but Philip agreed that everyone gets a deal except China. And if everyone gets a deal, we are part of that as well. We don't know when, how, but that looks like the end game. But of course, China is the real target, as Philip said. 0.5% lower, 0.6% lower on the Nifty, 22,400. So it's 170 odd points down. The Sensex is down 500, 73,726. Advanced decline is about 1:1. Nifty Bank is down about 1/3%, doing much better than the Nifty. And the mid-cap index is down 0.5%, and I think the small-cap index is starting lower as well. Nifty heat map will give you a quick snapshot view of the red and green up there on the screen. And what do we have? I think it'll be 40-odd names, 38-odd stocks lower, and some stocks are higher as well. So,
the pre-open was a bit of an illusion. So it is actually in sync with the implied open. This 150-point drop. IT is taking it on the chin. These are the first stocks I'm looking at, given what Rima just told us, that Jeffrey's note is really negative and big-time downgrades and cuts across price targets. Look at Memphis's, for instance, down about 4%. Coforge is down about 3%. LTI Mindtree is down about 1.5%. That's the mid-cap and even large caps. Wipro is where they see the maximum risk to the price target. I mean, they've cut the price target the most, citing discretionary exposure. That stock's down about 3%. Aside of that, Pharma is also nervous in selling off for very obvious reasons. They're the next target, and we don't know by how much. 3% on Dr. Reddy's. Cipla is down about 2%. Sun Pharma is down about 2%. So Pharma and IT are very, very nervous this morning. Beyond that, there's some weakness on metals. Tata Steel is down. There's also names like L&T on the lower side, JSW Steel on the lower side. Titan is cooling off very, very rapidly. It had a good run yesterday. Today it's down about 1%. On the flip side, okay, let's see where the gainers are. Power Grid, Bajaj Auto, some FMCG names like Lever and Nestle. And that's it. Everything else is fizzling out. It's shaky and weak to begin with.
Transformers and rectifiers up close to around 5%. The management joined us just around 45 minutes or so ago. They were sounding very optimistic about the prospects of the company. The street likes it. So yesterday it was up 5%. Today it's up another 5%. Senco, that one as well came out with an operational update. The street liked it. And that explains why that stock as well is holding higher in today's trading session. I think it's up close to around 5%. Yeah, both of them. Volumes fairly okay actually on both those two names. So that's some green on the screen. Berger Paints, because of the drop that we're seeing in crude oil prices and hopes that demand are going to be better, we have Berger Paints that's up 1.5%. The screen is otherwise red, but a couple of these names are doing well. Actually, some of these paint companies, the OMCs as well, HPCL as well as BPCL, there was some buying that we saw on both those two names. So let's get them up for you on the screen. Yesterday, IGL pulled back because of that negative news flow with regard to the CNG vehicles. Let's see what it's doing today because it ended at the low point of the day. It's down another 1.5% or thereabouts. But it's a decent start in the first few minutes. The Nifty Bank, that's the one that's on the verge of moving into the green. And if we need to see a fight coming in today, probably it's the turn of the Nifty Bank, given that tech as well as Pharma are relatively weak.
And on Pharma, I just wanted to add that it's not just your large cap names like Sun Pharma, Dr. Reddy's, etc. Look at everything in Pharma across the board. Lupin, Aurobindo, Biocon, Ipca, Loris, Gland Pharma. I mean, these are stocks, walk hard. Everything is down between 3 to 5.5%. Lots of nervousness about what next.
Well, he's sort of said pharma tariffs are coming and markets, of course, are reacting for the second time, actually. In the last 5-6 days, this is happening. For the first time around, the impact was much larger. Pankaj Tibrewal is with us, founder and CIO at Ikigai Asset Managers. Pankaj, good to have you back on the program. Prashant here. Let's just start with pharma as a space. I know you have some sort of broader thoughts on the entire situation as well. And we'll get to that, and maybe we can do this slightly in the reverse order. I'll start by asking you about the most pressing sectors. So pharma first, Pankaj. How are you thinking about this? China is the API factory of the world. Tariffs are all, as the last guest also told us, the real target is China. And I mean, the idea was everyone else gets a deal except China. But, Trump is saying that pharma tariffs are also coming. So for the Indian listed pharma universe, what are implications and what are your thoughts? Pankaj, hi.
So Prashant, if you look at the pharma sector, our thoughts are a little different. If you go by logic, which is not prevalent today, I think he should not touch generics. I think his entire thought is to go after big pharma. And a large part of profits of big pharma, if you look at, is sitting either in Ireland or Cayman Islands. And his thought is that you should bring that profit back to US. And you saw that some of the large pharma companies like Lilly announced about a $50 billion capex. Even if you think about manufacturing going back to US, the Indian generic companies don't have a balance sheet and more than $8-10 billion which they can spend on capex in the US. So it won't make any difference. It won't move the needle. And don't forget that 90% of the volumes in US is generic. And out of that, 60% is supplied by India. So if it tries to touch generic pharmaceuticals, it will be completely suicidal for the US healthcare, in our view, because the cost would go up. And if you speak to any of the pharma companies, the margins are not so great that they can absorb this tariff increase. What will happen is that in a certain molecule, for example, if there are 4 players, 2 or 3 of them will vacate because it won't make sense. And the prices of the molecules, any which will go up because of the shortage. So in my view, even if you look at the last evening comment where the market is kind of reacting to it, he mentioned China and some other countries. He didn't mention India, just reading between the fine lines. So in my view, going by logic, he should not touch the generic pharmaceutical. I think what he is meaning is the big pharma, where he wants the manufacturing to come back to US. So my belief is that once the dust settles down, actually India pharmaceutical industry is in a better and a sweet spot, and especially the CDMO players. I think a lot of work which has flown to China over the last decade or two can come back to Indian players. So we won't get in a hurry and reduce our pharma exposure. Let the dust settle down, and then we'll take an informed call.
Okay, so keep the faith, ride it out. That's your advice on pharma. Got it, Pankaj. But yeah, let's see. I mean, you spoke about logic, right? Logically, this should happen. The problem is in the last, I think, 4-5 days, logic has gone out of the window. That's the only problem. But anyway, since we're talking sectors first and then the overall market view, let's talk about the other, IT. I mean, look at what's happening. I mean, this morning, Jefferies came out with a downgrade and their cuts, price target cuts are anything between 10% to 35% on stocks, mid cap and large cap. Obvious fears, obvious nervousness. What would you do here?
So on IT, I think directly, if you look at from an Indian economy perspective, there are 3 positives which are in front of us. I think one, though the 26% tariff may sound steep, but when we look at the comparing countries on manufacturing, whether it be, Bangladesh, Vietnam, China, the tariffs are much higher. In a way, it provides a competitive edge for us in many other areas. The second is our US exports is just 2% of our GDP, the manufactured good exports. So it should not be too much from an economic standpoint of view. And the third most important is, as we speak, the 2 large sectors, IT and pharma, have been exempted, which is roughly $40 to $50 billion from an export perspective out of $85-90 billion. So I think these 3 are the important, but the indirect impact is on IT definitely, because IT sector depends on the IT spends across sectors. And if the businesses are themselves not sure in this environment, the first thing they will do is cut the discretionary IT spend. So in our view, the growth could be much lower. We are going today, tomorrow is the first TCS results. I think most of the companies will refrain from giving guidance in this uncertain environment. They will hold on for a quarter to see how global environment shapes up and then come to a call. So I believe that earnings downgrade will probably go forward. And if I have to choose between one sector right now, between IT and pharma, I think it will be pharma for the time being. And once we see a 5 to 6% free cash yield on IT, I think that's the time when the downside will be limited, because finally these are cash throwing businesses, and at some point it becomes valuable from a portfolio perspective. But in the near term, I think uncertainty will prevail, and I think that's what markets are seeing, a sharp sell-off in IT in this month itself.
All right. Hi, Pankaj. Good morning. Always good to hear your thoughts. And, going by all you're saying, near term, there could be some pain. But in the longer term, India could come out much stronger from all of this, which will bode well for the economy as well as for the markets. So between tech as well as pharma, you're going with pharma. But what's your top bet? Because market conditions like these provide you good entry opportunities where you get good sectors, good stocks at prices you want. So what would be your top bet?
So, Nigel, I believe that domestic-facing sectors, whether it be banking, whether it be NBFCs, whether it be consumption, whether it be capital growth. I think most of the domestic-facing sectors probably will do better in this uncertain global environment. And we believe that many places the valuations have corrected meaningfully. There's nervousness across the street. And the consensus is that this year is going to be a very tough year from a return perspective. So in this environment, in the short term, I think we should get good bargains from an overall perspective. And we are looking from a portfolio construction quite constructively in looking at companies which have strong franchise, which can gain market share. Nigel, nobody is talking about many Indian companies, Indian entrepreneurs gaining market share because they are cost competitive. They are far more productive in the last decade or so. So in my view, many companies and sectors you could see Indian companies gaining market share at the expense of some of the other competing nations. And we have to watch out. And one more important trend which I am seeing, I think which should be brought to notice, is the divergence between the index return and the median return of the index. Last quarter, which is the fourth quarter, the NSE 500 index return was negative 6.5%, but the median return of that index was negative 12.5%. 6% gap is one of the highest we have seen in the recent last few years. And that shows that the few stocks in the index is holding the index higher, but the breadth of the market has been extremely poor. So our sense is that this will be a stock pickers market. Going forward, you have to make sure that you are betting on right franchise, right businesses, right promoters, and navigate this without losing capital. And I think one needs to keep on checking whether the business model has been fractured or it's got stronger. So I think it's a classic next 18 to 24 months will be a bottom-up stock pickers market. And the easy money era, which we saw for the last 3-4 years,
which is a point you've made, which is a point you've been making, and I think absolutely bang on. Pankaj, one specific area. So I have two questions. One, which are these companies where you think market? Let's talk companies, if you will, where there could be market share gains. Second, you had a view on chemicals, a positive view on chemicals, and now that, according to some sector, which gets hit because of these tariffs. I'm sure you would have looked at. And your view was own a bunch of these chemical companies, and actually there was a bit of a recovery which had started. Maybe that it is still on and the stocks have come off the lows. But what's the impact there? Yeah.
So if you take a slightly medium to long-term view, Prashant, the largest country manufacturing chemicals is China. And we are a very small drop in the entire ocean. I think it's a great opportunity for Indian chemical companies to gain market share. The export data which just came some time back yesterday, it's very encouraging to see a very strong growth across chemical companies on the export market. And I believe that if manufacturing has to be protectionist, chemicals will find its favor across, and Indian chemical manufacturers across CDMO, CSM, as well as some of the important areas where they are focused on domestic market should gain prominence. From a result perspective also, I believe that though index will give you 11, 12, 13% return, but many of these companies are so well positioned and they have a low base coming in that this year we should see a 20-25% growth in across many companies. And fourth quarter in our preview is looking very healthy for most of the chemical companies as you move ahead. So don't forget that the next 12 to 18 months, it will be growth along with quality as a factor, which should outperform over a period. And I think companies which can deliver above market returns in terms of growth should find favor among investors. And chemical is one sector where I believe that India has a brilliant opportunity to gain market share at the expense of Chinese. And across the board, I think we are very cost efficient now from an overall perspective. So I think I'm quite okay with chemicals as a sector. Need to monitor it regularly, but I think companies have a very strong moat. The second important part is don't forget that China is a very important piece in the entire metal supply chain. Prashant, you'll be surprised to know that there's a small alloy called anti-money alloy. Just go and search on Google. That alloy is used for ammunition, battery storage and stuff. China decided not to export. And in the last few months, the $10,000 price has shot up to $65,000. And US doesn't produce it. China has 65% market share. And once China stops, the prices just went 6x. And US can't supply ammunition across the world in terms of bullets. So don't ignore that China is an important piece across different commodities. And if China decides not to export or stop the supplies of these, I think a world will have problems. So in many commodities, you could see inflation coming back very significantly. And if it happens in chemicals also, it could be good news for Indian manufacturers.
Okay, so absolutely. I mean, it's not like China doesn't have any chips to bargain with, rare earths, some of these specific, materials, like you said. Definitely, that will be their bargaining chip. And then, like our previous guest said, there's the nuclear option, US treasuries, right? So let's see how this plays out. Thank you very much, Pankaj. Great to get that perspective from you this morning. We look forward to connecting again soon.
Surbhi, before we take a break, if I can just point out, I saw this flash. The 10-year is now, the US 10-year is now 4.5, which basically means we've seen a 20 basis point moves from yesterday's close. If you can have that line up on your screen, that is humongous. 4.48. Wow, that is a very, very large move. I mean, actually, stock markets are, the lesser problem in that sense now, if yields are moving the way they are.
It's not just the yield, Prashant, that's moving. The equity futures have completely dunked again. Dow futures are about 500, 600 points down. S&P futures are down about 1.6%. Same for NASDAQ. So equities down and yields seem to be rising.
I think
higher.
there was an auction yesterday, in the US, and I think it was.
But that would have shown
that was
through
during trading hours.
This is after close a 20 basis point move.
Yeah.
I mean, and I think we should pay attention to this and maybe get views on. We have a whole panel joining us at 9:45 to talk about the RBI, and I think we should discuss this as well. So two things have happened.
But I don't think, Prashant, it's not a 20 basis point move, because this morning, before we at around 6:30 a.m. in the morning, it was already at 4.36, 4.37. So it's actually a 10 basis point move, which is not small, but it's not 20 basis point. Because earlier this morning I put out a note.
What I'm saying is, yesterday we closed at 4.29. We're at 4.5, nearly 4.5. It's a 20 basis point move from yesterday's close in New York, the rates market close.
Right.
So it's a very large move. And the point is that, essentially the market, the realization is now kind of creeping in that these tariffs are here to stay. This 104 tariffs have gone into effect. These reciprocal tariffs have gone into effect. That is, I think, what is happening. The yuan, by the way, what has also happened is that the yuan move is hitting Asia Forex in a very large way. You look at what's happening to the Indonesian rupiah. If you have rates, look at the Korean won. I think multi-year lows on all these currencies.
It's midnight in the US, 9:30 our time. Now you know why these moves are happening. It's symbolic.
It's
the tariffs have
9:33 now.
kicked in.
Yeah.
And this is the reason you're seeing these dramatic moves across currencies, across rates. Why suddenly US futures have dipped further? It's just to acknowledge the reality.
We should actually...
US tariffs
We should
are
actually
a
put out a flash as well. It's 9:30, 12 their time, right?
So 9:33, our time 9:33, which is 12 o'clock midnight US, tariffs were supposed to come in. Tariffs are official, reciprocal tariffs are here, and the markets are, for what it's worth, acknowledging that with a further sense of unease.
That's the flash.
Yeah, that's the flash.
US tariffs will come into effect, and, as they say, sometimes you've got to wait for it to actually happen to believe it. And now it has happened. We're 3 minutes in. And
it's
we've got a
4.51, by the way, the 10-year yield. I mean, it's not stopped. When we started this check, it was just under 4.5.
Yeah.
4.51 is just reacting to the reality of it. I mean, we knew it all along. Markets knew it all along.
Yeah.
But it's real. It's official. Those tariffs have come in on all US trading partners.
And what we'll do is we'll also put out some lines on what's happening with Asia Forex. The rupee, of course, is lower. But I think the low was about 88. The high on the dollar rupee was about 88. We are, of course, 86.57 or whatever, about 1/3% move. But many other currencies are down 0.5%, 0.6 odd percent, and we'll sort of put that up as well. But this is essentially, the tariffs taking effect and markets paying attention now and reacting to the fact that maybe this is here to stay and this is going to be protracted. And there is no deal, because there were lots of, obviously one would hope that before the 9th of April, there will be some deal, people will backtrack. I mean, it's just human nature to hope something will happen. But we are past that point, and the tariffs have now gone into effect.
And yeah, I'm glad they fired the dollar yen, because there is a rush to safety. So typically you see, the yen as a safe haven. So it's strengthened even more, 145. The euro is rallying. I mean, in all this, the euro is typically been stronger. And that move is continuing. So 0.5% increase on the euro, 0.5% appreciation of the yen, while other currencies continue to tumble.
Absolutely. So this is the big story which we will continue to track in terms of the market reaction there is. We'll take a quick commercial break as well, because, there is a fair bit happening here in India as well. That, Delhi EV policy, etc., also in focus. So we have a couple of important guests joining in to talk to us about that. Stay tuned. Coming right back up.
Welcome back. Actually, given the kind of immediate moves in global markets as these tariffs come into effect, our market hasn't fallen too much. It's the same 150-point dip. Pull up the intraday chart on the Nifty if we can. There you go. So it's not like suddenly our market has taken a nosedive because of the risk-off sentiment that's playing out elsewhere, which is good, which is a good thing. So not too bad. We'll get Mitesh in just a bit to talk about further trading strategies in this environment. But for a brief bit, let's just look away from US tariffs to something which happened here yesterday back at home. And it was fairly dramatic as well. The Delhi government's draft EV policy 2.0 has recommended phasing out of CNG-driven auto rickshaws, petrol and diesel vehicles as well. Yesterday, IGL, of course, was under quite a bit of pressure on the back of that development. So how can this perhaps play out? Will companies' launch pipelines be impacted? Let's get in some thoughts with Mr. Venkatram Mamilapalle, country MD and CEO at Renault India, and Arun Malhotra, auto industry expert and former MD of Nissan. Gentlemen, thank you so much for joining in. And that's really the point, because if I go back and look at what the policy is proposing, and we'll just put up those graphics. So no CNG auto rickshaws, no three-wheelers which can be CNG or petrol or diesel, starting from Independence Day this year. That's just a couple of months away. And not just that, they're also saying that no CNG or diesel or petrol two-wheelers from next year, which is 15th August 2026. So they're really accelerating the timeline. So in this context, your first thoughts, if I could come to you first, Mr. Venkatraman, will this hurt industry's immediate plans? I mean, this is Delhi going all EV suddenly.
Yeah, thank you for having me. Good morning to all. What is important is health of the people. So we know what's the air quality index in Delhi, and it is important that government takes some steps. Auto is just a portion of it, and we know that there are many other factors which are engaged in bad air quality index, what we have. However, the movement towards EV is a right step, but moving at a speed at which the adaptation will become a challenge is an issue. So first of all, we need to have the ecosystem. I don't think that we have the ecosystem which can take the changes so fast. And therefore, it is necessary that we first engage in the ecosystem development as government, and then put the regulation and policies, which are still in the draft, by the way, into force as quickly as possible. No doubts that we as a nation have to take a leapfrogging steps, but before that, we need to do our homework. So in my opinion, this seems to be too fast, but it's in the right direction.
Okay, seems to be too fast, but in the right direction. Mr. Malhotra, if you could comment on this, sir. I mean, I don't know how disruptive this can be for existing OEMs. People have capacities. I mean, CNG, whether it's even petrol, diesel, I mean, big capacities. Is it going to be very disruptive specifically for the three-wheeler and the two-wheeler space?
So, let's take two-wheelers and three-wheelers separately. As far as three-wheelers is concerned, this is about 20 years backward story. Sheila Dikshit's time when the CNG was introduced, and that was seen to be a landmark move. Delhi was far ahead. Now, CNG is everywhere in Delhi as far as three-wheelers is concerned. So this shift, welcome, because definitely EV is a much more purer fuel or much more less polluting fuel than CNG. But I don't think we are absolutely ready for it. Just to take a basic case, Delhi is the largest market for three-wheelers. And today, if you have to combine, slice the market between passenger and commercial application, which is load application, load vehicles, CNG, EV vehicles are just not available. And even CNG charging infrastructure, petrol or EV charging infrastructure still is a constraint. So that's be a big challenge at this point of time. But I think August 25 is a very, very aggressive move. The way government policies follow, the note paper will agree, it will get watered down or get delayed. But I think manufacturers will start thinking of it. That's the positive part. As far as two-wheelers is concerned, one of the challenges today, and probably it will remain till next year, all the EV two-wheelers in the market are basically scooters. There are virtually no motorcycles, EVs available. And 2/3 of the market is motorcycle. And I don't see any dramatic change coming in the next 1 year. So probably we have to wait and watch and we have to look at it. But definitely a step in the right direction. Most companies which manufacture CNG vehicles also have EVs in their portfolio. So they have the opportunity to ramp it up and reduce CNG. But how will it happen? That's a $1 million question. And we don't want the scrappage policy to the way it has happened. The way it is announced and the way it's implemented, it's a very watered down thing. You need to go have clear steps, but go slowly and steadily rather than going hogwash and then not implement it.
Okay, I think we are getting visuals as well of the RBI governor. That's, of course, the big event for us here locally in India. Just minutes away, 10 o'clock is the policy announcement, and we're widely expecting a 25 bips point rate cut. At least some are saying it could perhaps even be as much as 50 basis points. If I could just come back to Mr. Mamilapalli, what would your prescription be? This is still a draft sort of policy, so we need to see if it is, if it is changed and maybe those timelines are relaxed a little bit. What would a realistic assessment be in terms of when to roll this out if you support full EV fleet for two-wheelers and three-wheelers?
See, as I said before, ecosystem is the key. And you are not looking at just the two-wheeler, three-wheeler, but you have to look at the whole auto industry as such. With BS 6.2 emission norms, which was just implemented, and the whole industry have just embraced the new emission norms. And further, we are talking about CNG adaptation, which is, again, well-versed within the NCR region. We should give enough time, at least about 4 to 5 years, at least, for the migration. Anyway, for the passenger car, where we are predominantly in existence, it's very minuscule contribution to the carbon monoxide emissions. So we have to be diligent in what we are doing it. We have other factors which are influencing the air quality index, and that needs to be attended much, much faster than the policies which we are currently putting as draft today.
All right. Okay, gentlemen. Thank you very much for weighing in on this. This is right now a draft proposal. Let's see what the final guidelines look like, and then perhaps we'll have you back to weigh in on them. That's the Delhi EV policy, something that's still within the realm of discussion. Markets actually recovered. This is not too bad. Market is now down just about 80 points from a 150-point dip. There's a lot of buying in FMCG. Look at Lever, look at Nestle. There's buying in ITC. So FMCG is indeed proving to be a bit of a safe haven. Mitesh is back with us. Mitesh, your sense on the overall trade, and definitely a specific word on IT, which is getting hit very hard, and whether you see any trades in FMCG on the upside.
Good morning again. So I think FMCG is something which I like a lot. In fact, last few days, the buying calls have been like, Colgate and HUL, and even right now I have a buy on HUL. You are highlighting ITC, that's also looking very strong on the chart. So that's a defensive pack, I think, which could do well in a market which is slightly choppy and volatile. So FMCG is definitely yes. IT is getting oversold, but I still haven't got any sign of reversal as yet. So, what I would want to do is see if there's some kind of a reversal on the hourly, 2 hourly charts, and then fish for some long side trades with the tight stop loss. But that still is a couple of days away, it seems. On my recommendations, I have, as I mentioned, a buy on HUL. That's a buy with a stop just below levels of 2294 and look for a target of 2360 here. And Hindustan Zinc, I think that's a stock which is a negative call, a sell call. With a stop at about levels of 408 for targets of 385.
All right, that's essentially trades coming through. 80 points lower, 22,451 is where we are at. But our policy coverage begins. And what a really complex, environment for the RBI to have met. And the point is, the meeting started on Monday. We are on Wednesday. And what they would have discussed on Monday, at least from a global angle, that has changed so much. I mean, just look at the US 10-year, which is the risk-free rate. That's moved up since Monday, when they would have sort of started discussions by almost about 30, 35 basis points. So just amazing. But we have a whole host of experts talking to us, to talk to us about what the action could be like, and of course, post-action implications. So that's coming right up. My colleague Ritu will come in, take you through that conversation. And of course, our Lata is at the RBI HQ. Stay tuned.
Hello and welcome to our special coverage of the Reserve Bank of India's monetary policy, coming to you straight from Mint Street, from the RBI headquarters. As policies go, this is a crucial one. It's a time when it's difficult to make any assessment of growth or inflation or even interest rates. On Monday, as Prashant was saying, when the Monetary Policy Committee began its meeting, the US 10-year yield was at 3.95. Today it is at 4.49. I mean, it's a 55 basis point rise in just about 3 days. Yields are all over the place, currencies are all over the place, and growth rate expectations are all over the place. My colleague Ritu Singh joins me from the studios, and we have a whole host of experts. Ritu, good morning. A quick summary of market expectations, please.
Good morning, Lata. Well, we're going into this policy with a unanimous expectation of a rate cut. The majority view, of course, is a 25 basis point rate cut from the MPC. But the question really is what else? Could be a larger rate cut, but that is a very small chance of that happening. Whether the MPC decides to change its stance to accommodative, that is something the street will be watching out for. Our poll also says that there is a high chance of that happening, although a good 40% do believe the RBI will still stick with a neutral stance given the uncertainty in the markets. Now, as far as the terminal repo rate is concerned, these expectations have been moving from policy to policy, and now the expectation of the total rate cuts in this entire cycle is 100 basis points. So another 75 basis points coming, taking the terminal rate to about 5.5%. Apart from that, no additional liquidity easing measures really, because RBI has been taking steps outside, whether that is OMO, VRRs, forex swaps and so on. And it is expected to continue to do that. But any more positive commentary, that will be keenly seen. On the GDP front, some sort of headwinds are expected because of the US tariffs and, other factors. But largely, the street expects for now, the RBI may choose to leave the forecast unchanged at 6.7% for the fiscal. A small section is expecting a slight downward revision. On the CPI front, 4.2% again, likely to be left unchanged, although there is a possibility that RBI lowers it to about 4 to 4.1%. That will also be seen as sort of a dovish tilt. The tone, of course, is likely to be dovish and sort of indicate, the roadmap for future rate cuts. So that's what we're going into the policy with, but never second guess the RBI. We'll see what else comes out.
Absolutely. We have a host of experts to give their views. We have Parul with us, who heads the Treasury Standard Bank, Kaushik Datt, the Chief Economist from Deutsche Bank. And then we are going to be joined by Indranil Pad of Yes Bank, Lakshmi Iyer of Kotak, Devang Shah of Axis Mutual Fund. But Parul, let me come to you. I think the 10-year is at 6.48 now. What's priced in? And do you think it's just going to be a cut of 25 bips, or it will be cut plus something?
Hi, Lata. Yes, market is going very positive with very high expectations. What's priced in is fully a 25 basis points of rate cut, along with high expectations of a change in stance of accommodative and some dovish tone from the government. That's already priced in, so even after a large move higher in rates overnight in the US market, you see that the market impact India is very much primarily because of positive expectations from the upcoming uncertainty.
Yeah, Parul, I don't think we have a very clear line over there. We'll come back to you. Kaushik, I'll just come back to you. I think we'll correct that audio issue. Kaushik, what are the chances that you will get a lower growth rate? It's really impossible to stand with the 6.7% at this juncture. What's the growth rate you are expecting? And will that be seen as dovish?
Lata, good morning. So we have a lower growth forecast of 6.5% for FY26. RBI is at 6.7. Now, one argument could be that RBI could wait for the January-March GDP data to come out on 30th May, which may again come out with a lot of revisions. And then RBI can take an informed decision to change the forecast in the June policy. So that is one way to think of it. The second is if RBI feels that 6.7 forecast is already a little high, and the tariff developments that have taken place should be, done mark to market, then they could think of bringing it down closer to 6.5%. And that will give a more realistic kind of a picture. And the risk is that the growth of 6.5% could be even lower if the global growth slows down and we are into a recession by the end of the year. India's growth could fall closer to 6% as well. So whether the RBI does mark to market in this policy itself or they wait for a little bit more time, but the bias to growth is on the downside. And also the bias to inflation for FY26 also is to the downside compared to the 4.2% that RBI has taken at this point of time. The March CPI number is supposed to be around 3.5. And you could easily have FY26 inflation coming closer to 4%, but RBI could keep some buffer and not change that right now, given the heat waves that we are seeing. So 1 or 2 months of bad inflation data can pull it up again. So maybe they could go with unchanged 6.7, 4.2, but the bias is downside for both inflation and growth. And that is why I think this is an opportune time for RBI to change the stance to accommodative, because if they're cutting rates 50 basis points by April, it's no point holding on to the stance of neutral if you know that you're not going to hike rates anytime soon. So it can either be a pause or a rate cut. You don't need to wait till the end of the cycle to change the stance to accommodative. So this is a good time to change the stance to accommodative and give hint to the market that the cycle could be a bit deeper. And RBI is not thinking of any rate hikes or anything. And at this point of time, the focus would be more on supporting growth, given that inflation is already pretty well behaved.
Yeah. Kaushik, I have to interrupt you because we don't have that much time and we have a lot of guests. Imran Irfan, what can make banks cut rates? If the governor were overtly dovish, like he brings down inflation rates or inflation forecast, or if he says we will keep liquidity surplus, I mean, hypothetically, at say 2 lakh crore, let's suppose he gives some assurance, will that bring down deposit rates? What will lead to a deposit cut?
Well, I think banks have already started to cut deposit rates. Immediately after the previous policy, when we had a 25 basis cut, the banks did not react because of the tightness in the liquidity. Now, obviously, we know and see that the RBI is more open to providing liquidity into the system, and there is at least a minimum of 50 basis points. And as your other guests also point out, there could be a deeper rate cut story given the forecast for inflation in the next financial year at about 3.8 to 4%. So given that, I think banks have already started to cut deposit rates, and first quarter we are expecting liquidity to remain adequate, which should to a certain extent bring down the cost of funds. Having said, we will also have to watch out in terms of what is happening to the bond yields. And the bond yields today, even though we have a 25 basis points cut, estimate the bond yields actually have risen. And you have already mentioned the way the volatility in the US treasuries are being experienced. So it will be a sort of a watch episode in terms of how fast the banks could actually react in terms of the rate cutting story of the Reserve Bank of India.
All right. Lakshmi, what are your base case expectations going into the policy? Apart from the rate cut, what are the specific cues in the governor's tone and his speech that you're going to watch out for to indicate the sort of dovishness we should expect going forward?
Yeah, sure. So I think firstly, tariff shock is equal to rate cut therapy. I think that formula is something which central bankers, including RBI, will imbibe today. The second thing is the continuity in terms of rate cuts. So maybe if we started the year, our expectation was no more than 2 rate cuts in the entire year. Now that view is clearly changing given the macro situation, which is pretty, fluid globally. And I'd say that the crux is going to be to see obviously the stance change. Is there a catalyst to do that today? Probably yes. Is it going to be a slam dunk? Maybe not. So I think that is something which we will clearly watch out for in the text. And secondly, as I mentioned, is there going to be continuity in the rate cut cycle, which probably is definitely warranted given the situation. And of course, as I said, we're not really rooting for significant cuts on the GDP growth front, but that could be well the cue in terms of a watchword. But I think dovishness all along should be what markets have baked in. And that's something which will be a text that we all will look forward to.
Okay. Well, Parul, if we can get you, if you're lucky this time, just tell us what we should watch out for. Train our eyes.
So we should just watch out for, one, whether the stance change is happening or not. And second, the tone of the policy. Is the governor giving any indications of inflation being well under control and giving space to the MPC to keep supporting growth through monetary policy channels going forward? So that's the main thing to look out for. A lot of dovishness is priced in. Market is priced in 75 basis points of rate cuts over the next few months. So a dovish tone from the RBI governor will be very important to watch out for.
And Devang, thanks for waiting by. Quickly, what have we not covered? Any other surprises you think that could be in store?
So I think largely all the panelists have covered everything. From our perspective, I think markets have gone significantly dovish into this policy, and markets are expecting a lot from RBI. So our view is that probably there might be a bit of disappointment because RBI might want to keep some of the gunpowder in this uncertain environment where you can have currency or tariff wars coming up.
All right. Thanks, Devang. We have the Reserve Bank of India Governor Sanjay Malhotra. Let's cut in.
The year has begun on an anxious note for the global economy. Some of the concerns of the trade frictions are coming true, unsettling the global community. We at the Reserve Bank, while remaining alert to these global developments, began the year celebrating the completion of 90 years of this august institution since its inception way back on 1st April 1935. The Reserve Bank's journey over the last 9 decades is closely intertwined with the nation's development and progress. As a custodian of monetary and financial stability, the Reserve Bank has evolved itself over the years into a full-service central bank with varied functions facilitating a market economy. Indeed, a very, very long journey full of accomplishments and achievements, something which every RBI is proud of, and something I believe the whole of India and its citizens are also proud of. In this challenging global environment, the Monetary Policy Committee met on the 7th, 8th, and 9th of April today to deliberate and decide on the policy repo rate. The global economic outlook is fast changing. The recent trade tariff-related measures have exacerbated uncertainties, clouding the economic outlook across regions, posing new headwinds for global growth and inflation. Amidst this turbulence, the US dollar has weakened appreciably, bond yields have softened significantly, equity markets are correcting, and crude oil prices have fallen to their lowest in over 3 years. In fact, as we speak, it is about $60 to a barrel. Under these circumstances, central banks are navigating cautiously with signs of policy divergence across jurisdictions, each reflecting their own domestic priorities. The Indian economy has made steady progress towards the goals of price stability and sustained growth. On the inflation front, while the sharper than expected decline in food inflation has given us comfort and confidence, we remain vigilant to the possible risks from global uncertainties and weather disruptions. Growth is improving after a weak performance in the first half of the last financial year, 24-25, although it still remains lower than what we aspire for. And now I come to the decisions of the Monetary Policy Committee. After a detailed assessment of the evolving macroeconomic and financial conditions and outlook, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 6% with immediate effect. I repeat, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 6% with immediate effect. Consequently, the standing deposit facility, the SDF rate, under the liquidity adjustment facility shall stand adjusted to 5.75%, and the marginal standing facility rate, or the MSF rate, and the bank rate shall stand adjusted to 6.25%. I shall now briefly set out the rationale for the decisions of the Monetary Policy Committee. The Monetary Policy Committee noted that the inflation is currently below the target. It is supported by a sharp fall in food inflation. Moreover, there is a decisive improvement in the inflation outlook. As per projections, there is now a greater confidence of a durable alignment of headline inflation with the target of 4% over a 12-month horizon. On the other hand, impeded by a challenging global environment, growth is still on a recovery path after an underwhelming performance in the first half of 24-25, which is the last fiscal. In such challenging global economic conditions, the benign inflation outlook and the moderate growth demand that the MPC continues to support growth. Accordingly, the MPC unanimously voted to reduce the policy repo rate by 25 basis points to 6%. Moreover, it also decided to change the stance from neutral to accommodative. It also noted that the rapidly evolving situation requires continuous monitoring and assessment of the economic outlook. Let me now dwell a little on the monetary policy stance. This has been a subject of interest for some commentators and market participants. There have been questions as to whether it means a change on the policy rate or whether it signifies our stance on the interest rate or whether it relates to liquidity conditions. From a cross-country perspective, monetary policy stance is typically characterized as accommodative, neutral, or tightening. While an accommodative stance entails easy monetary policy that is geared towards stimulating the economy through softer interest rates, tightening refers to contractionary monetary policy, whereby interest rates are hiked to restrain spending and curb economic activity, all with the objective of reining in inflation. A neutral stance is typically associated with a state of economy which neither calls for stimulating economic activity nor calls for controlling inflation by curtailing demand. Therefore, it provides the flexibility to the central bank and the MPC to move in either direction on the basis of the evolving economic conditions. In our context, the stance of monetary policy signals the intended direction of the policy rates going forward. Accordingly, with respect to the policy rate, which is the mandate of the MPC, today's change in stance from neutral to accommodative means that going forward, absent any shocks, the MPC is considering only two options, that is status quo or a rate cut. Let me also clarify that the stance should not be directly associated with liquidity conditions. While liquidity management is important for monetary policy, including decisions related to policy rate, it is an operating tool with the RBI for various purposes, including monetary policy transmission. Monetary policy decisions to change policy rates do, however, have implications for liquidity management, being the operational tool to carry out the policy changes. To summarize, our stance provides policy rate guidance without any direct guidance on liquidity management. I will, of course, be discussing later our approach to management of liquidity. Before now I share our outlook and assessment of the growth and inflation, I think a few words on the implication of the recent global trade and related policy uncertainties are in order. Let me first highlight the possible implications for growth. First and foremost, uncertainty in itself dampens growth by affecting investment and spending decisions both of businesses and households. Second, the dent on global growth due to trade frictions will also impede domestic growth. Third, higher tariffs shall have a negative impact on net exports. There are, however, I may say, several known unknowns. The impact of relative tariffs. Our relative tariffs vis-a-vis some of the other countries are quite low. Then there is the unknown of the elasticities of our export and import demand and the policy measures adopted by us. You are all aware that India is very vigorously and proactively engaging with the US administration on the foreign trade agreement. These are just to name a few. These make the quantification of the adverse impact on growth difficult. The risks to inflation, on the other hand, are two-sided. On the upside, uncertainties may lead to a possible currency pressure and therefore imported inflation. On the downside, slowdown in global growth could entail further softening in commodity and crude oil prices, putting downward pressure on inflation. Overall, while global trade and policy uncertainties shall impede growth, its impact on domestic inflation, while requiring us to be vigilant, is not expected to be of high concern. Coming now to our growth outlook. Real GDP, as you are all aware, this year, as per the MOSPI figures, is expected to grow at 6.5%. This is on top of a 9.2% growth rate observed in the previous year, which is 24-25. In 25-26, the current year, prospects of agriculture sector remain bright on the back of healthy reservoir levels and robust crop production. Manufacturing activity is showing signs of revival, with business expectations remaining robust, while services sector activity continues to be resilient. On the demand side, bright prospects of the agriculture sector bode well for rural demand, which continues to be healthy, while urban consumption is gradually picking up with an uptick in discretionary spending. Investment activity has gained traction and is expected to improve further on the back of sustained higher capacity utilization, government's continued thrust on infrastructure spending, healthy balance sheets of banks as well as the corporates, along with the easing of financial conditions. Merchandise exports will be weighed down by global uncertainties, as mentioned earlier, while services exports are expected to remain resilient. Headwinds from global trade disruptions continue to pose downward risks. Taking all these factors into consideration, real GDP is now projected for this fiscal 25-26 at 6.5%, with Q1 at 6.5%, Q2 at 6.7%, Q3 at 6.6%, and Q4 at 6.3%. While the risks are evenly balanced around these baseline projections, uncertainties remain high in the wake of recent spike in global volatility. You would have noted that the growth projection for the current year has been marked down by 20 basis points relative to our earlier assessment of 6.7% in the February policy. This downward revision essentially reflects the impact of global trade and policy uncertainties, which I had highlighted a little while ago. Coming to inflation, the headline inflation moderated during January-February 2025 following a sharp correction in food inflation. The outlook for food inflation has turned decisively positive. The uncertainties regarding rabi crops have abated considerably, and the second advance estimates point to a record wheat production and higher production of key pulses over that last year. Along with robust kharif arrivals, this is expected to set the stage for a durable softening of food prices. Sharp decline in inflation expectations in our latest survey for 3 months and 1 year ahead would also help anchor inflation expectations going forward. Furthermore, the fall in crude oil prices augurs well for the inflation outlook. Concerns on lingering global market uncertainties and recurrence of adverse weather-related supply disruptions, however, pose upside risks to the inflation trajectory. However, I may add that as per the latest forecast by various organizations, national and international, including our own Indian Meteorological Department, the monsoon is expected to be normal, and the El Nino effect is also expected to be absent. So these are positives for us. Taking all these factors into consideration and therefore assuming a normal monsoon, CPI inflation for the financial year 25-26 this year is projected at 4%, with Q1 at 3.6%, Q2 at 3.9%, Q3 at 3.8%, and Q4 slightly higher at 4.4%. The risks are evenly balanced. I now will be speaking on the external sector. India's services exports remained resilient in January-February of this year, driven by software, business, and transportation services. Going forward, net services and remittances receipts are expected to remain in large surplus, partly offsetting the trade deficit. The current account deficit for last year as well as this year, 25-26, are expected to remain well within the sustainable level. On the financing side, gross foreign direct investment, FDI, remained strong during the period of April 24 to January 25. Last year, which is the latest data, period for which we have the latest data, reflecting India's strong macroeconomic fundamentals. Net FDI, however, moderated sharply during this period due to higher repatriations and outward FDI. Net FPI inflows to India stood at $1.7 billion during 24-25, supported by debt inflows as the equity segment recorded net outflows. This is much lower than what we had last year. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to that last year. As on 4th April 2025, India's foreign exchange reserves stood at $676.3 billion, providing an import cover of about 11 months. Overall, India's external sector remains resilient as the key indicators stay robust. I will now be talking about the liquidity and the financial market conditions. System liquidity was in deficit in January 2025, with net injection under the liquidity adjustment facility scaling a peak of more than 3 lakh crore rupees, in fact 3.1 lakh crore rupees on 23rd January 2025. However, as a result of a slew of measures, and I'll not go into the details thereof, you are all aware of them, of the various OMOs, the CRR rate cut, the swaps that we have done. The system liquidity deficit tapered, therefore, during last 2 months of February and March, and further it turned into a surplus on 29th March 2025. Further, coupled with the government spending picking up pace during the latter half of last month, March, the system liquidity further improved and it stood at a surplus of 1.5 lakh crore as on 7th April 2025, and even yesterday it was 1.4 lakh crore rupees of surplus. Reflecting these developments, the weighted average call rate softened and remained near the repo rate since the last policy meeting, the spreads of 3-month CP and 3-month CD rates over the 91-day Treasury bill rate have also softened since the second half of March, suggesting an improvement in liquidity conditions. I would like to mention over here again, I'm reiterating this, I've said this earlier, which is that the Reserve Bank is committed to provide sufficient system liquidity. We will continue to monitor the evolving liquidity and financial market conditions and proactively take appropriate measures to ensure that there is adequate liquidity in the system. Coming to financial stability, well, I do not have much to add from my previous policy statement in February. Things are more or less looking similar. The financial soundness parameters of the banking sector continue to be robust. The liquidity buffer in the banking system is well above the regulatory threshold. Profitability indicators are also healthy, reflecting robust operational efficiency of the system. Similarly, the system-level parameters of NBFCs too are very sound. Now, as has been the practice, I shall be announcing some additional measures. This time I have 6 additional measures to announce to all of you, and these relate to banking regulation, fintech, and payment systems. First, we propose to enable securitization of stressed assets through market-based mechanism. There is already a mechanism of securitization of standard assets. The same is now proposed to extend with modification to stressed assets, and I may add that this is in addition and this is not in lieu of the existing ARC route under the SARFAESI Act of 2002. Second, we have guidelines on co-lending. They are presently applicable only to arrangements between banks and NBFCs. Moreover, they are restricted to priority sector loans. To exploit the huge potential of such lending arrangements, it is proposed now to extend these to all regulated entities and to all loans, priority sector or even outside the priority sector. Third, loans against the collateral of gold jewelry and ornaments, commonly known as gold loans, are extended by regulated entities, both banks and NBFCs, for both consumption and income generation purposes in order to harmonize guidelines across various types of regulated entities to the extent possible, keeping in view their differential risk-bearing capabilities. We shall issue comprehensive regulations on prudential norms as well as conduct-related aspects for such loans. Fourth, to harmonize the regulations governing non-fund-based facilities across regulated entities, we propose to issue comprehensive guidelines. Instructions related to partial credit enhancement by regulated entities are also proposed to be revised. This is also, if you will recall, a budget announcement relating to NABFID by the Honorable Finance Minister in her budget speech for this year. This is expected to broaden funding sources for infrastructure financing. The draft of these 4 guidelines and regulations are being published today itself for public consultation, and we shall finalize these guidelines based on the feedback received. The other 2 announcements relate to, first of all, enabling NPCI to decide in consultation with the banks and other stakeholders the transaction limits in UPI for person-to-merchant transactions. This limit 2 lakh rupees. We will give the freedom to NPCI in consultation with other stakeholders to revise it as per the needs of the economy. I may also clarify over here that the P2P transaction limit, which is 1 lakh rupees as of now, will remain the same, and there is no change with regard to the regulations in regard to P2P or person-to-person payment transaction limits. The other and the last measure that I have to announce today is regarding the regulatory sandbox. We are making it theme neutral and on tap. At present, there are actually 4 themes on which people and businesses can work on this sandbox. Now we are making it theme neutral and on tap. Necessary directions for the implementation of these 2 measures shall be issued separately. To conclude, the global economy is going through a period of exceptional uncertainties. The difficulty to extract signal from a noisy and uncertain environment poses challenges for policy making. Nevertheless, monetary policy can play a vital anchoring role in ensuring that the economy remains on an even keel. In our context, as I mentioned earlier, the growth inflation trajectory demands monetary policy to be growth supportive while being watchful on the inflation front. We are aiming for a non-inflationary growth that is built on the foundations of an improved demand and supply response and sustained macroeconomic balance. As before, we shall remain agile and decisive in our response and put in place policies that are clear, consistent, credible, and in the best interest of the economy. Thank you, Namaskar, and Jai Hind.
Okay, so actually the governor has delivered as the market expected. There is both a rate cut and a change in stance to accommodative. The growth trimming is marginal, not a great deal, but I think the market will take the inflation reduction very, very positively, because that was kind of a clear signal that there is more space to cut rates. Now, 550 as the end rate of the repo rate looks like a given. If anything, it could be more. But growth has not been trimmed so much. Let me straight away get to our experts. Well, just as an added point, not much change in the regulatory issues. Maybe gold loans, we are going to see some new rules. But and co-lending, of course, has been liberalized or going to be liberalized a lot more. But nothing earth-shattering coming over there. Let me get to our experts very quickly. Upasana, what's the sense you're getting? Are you now going to change, from 4 rate cuts to something more? What are the first takeaways?
Lata, the kind of uncertainty that is brewing up globally, clearly the governor has highlighted that as well. Of course, the growth revisions are not reflecting that just yet. But having said that, the kind of emphasis that he has put on the global uncertainties, there is clearly much more room for rate cuts than what earlier we were pricing in. In fact, yesterday itself, we had revised down our terminal repo rate to 5 to 5.25. And just to highlight a couple of things, with the governor having talked about the stance change and providing clarity that, they want to have a clear guidance, they want to be growth supportive, and the stance change is suggestive of more support going ahead. I think these are 2-3 points which are very clear that they will be fairly proactive when it comes to addressing the growth challenges, which will definitely be showing up in the months ahead. So this is something which is very important. On the inflation front, clearly, life is much more simpler, comfortable, because, monsoons are expected to be normal. Overall, we are looking at inflation more or less anchoring around 4% handle with a possibility of a slight downside. But of course, we'll have to see the pace of rupee depreciation and the impact of that. But overall, I don't think there's much to worry on the inflation front. So I would say that the governor has delivered in line with expectations with a promise to act on a much more proactive basis going ahead as and when the need be.
Okay. Actually, you're right that bringing your repo rate forecast down to 5 and 5.25, because for the better part of this year, he expects inflation to remain below 4%, below their mandate. So I think the guess that the real rate, the neutral rate, can go below 5.5 really opens up, because it's less than 4%. Rajiv Anand, key takeaways?
I think in a world which is so focused on what's happening to tariffs, what's happening to tariffs, I think a central government that is focused on growth by cutting rates, by cutting its stance, I think is certainly positive. And I think the governor has also picked up the fact that in this tariff environment, oil prices will be down, US interest rates will be down, and I think that is positive for us from an inflation perspective. So all in all, I think it's growth positive. Yes, assets for banks will reprice sooner than later, but I think you will see a fairly sharp move on deposit rates as well. We've already seen non-retail deposits or CDs reprice from about 8% pre 31st March to about 7% today. And I think now you're going to see retail deposit rates also coming down quite quickly and quite sharply.
Okay, that really was going to be my question to Vinay Tonse. I mean, you will set the tone. Mr. Vinay Tonse, Managing Director, State Bank of India, is also with us. Mr. Tonse, you actually set the tone for the market. As Rajiv says, CD rates have already gone down. Now, do you think deposit rates are on their way down, and how much can you cut them? I mean, your loan rates are going to be 50.